Now let us discuss about inventory further and look at a case where inventory prices may change. So when prices change, how do you go about reflecting that in the balance sheet and the income statement? So this is what we are going to discuss now. So let's take an example. We have an inventory of, let's say, $1,000 which we have bought in year 0, and after some time we note that the inventory prices have changed to $1,500. So this scenario can be called as an up scenario. However, then there can be another scenario which is kind of a pessimistic scenario. Let's say the price of the inventory which you hold kind of decreases. So what do you do if these kind of situations actually happen? So when you bought the inventory, it changes to 1500 or it changes to 500. So individually there are different implications associated with it. So let us introduce ourselves to the concept of LCM. So this essentially means lower of the cost or the market. So what we essentially understand by lower of the cost or the market is that the balance sheet will carry an amount that is lower of the cost of the market. So let's discuss case 1 and see how it works. So case 1 is that the price should be lower of $1,000 and $1,500. So here the price would be $1,000, which is the lower of the two. So balance sheet would actually carry an amount which is equal to $1,000. Now what happens in the other case where the prices actually go down? The second case would be lower of the price, which is the cost price is 1,000 and the market price is 500. So what we note here is that this comes out to be $500. So the balance sheet in this case will actually carry an amount which is $500. So what happens when the balance sheet assets actually decrease? What exactly we do? Here we actually take a write-off of the inventory, and we'll see how this works in the income statement and the balance sheet with the help of an example now. So let us take an example here. Assume that the company has an inventory on its balance sheet at a cost of $55,000 and the management learns that the inventory replacement cost is $4,800. So essentially inventory has gone down. So it has gone down from 55,000 to $48,000. So what should we do in this case where we are talking about financial statements like balance sheets, income statement and cash flows? So here this is a clear case. We'll apply a concept of lower of the cost to the market value. So we need to find lower of the costs. The cost was 55,000 here and the market price or the replacement cost here is 48,000. So the lower of the two is basically 48,000 and this is what should go in the balance sheet. So essentially if we are doing that in the balance sheet, we are talking about the assets and the liabilities here on the balance sheet. Your inventory is actually going down by almost 7,000. So 55,000 minus 48,000 is 7,000. So we note here that the assets have actually reduced by 7,000. So there must be a corresponding decrease of 7,000 here as well, so that we can actually look at an equation which is assets which is equal to the total liabilities. So here we must have something which goes down by a similar amount, and this number actually flows from the income statement. So let's look at the impact due to income statement. What happens is when there is a write down of inventory of such sorts, we actually take an expense to an extent of the write down. So you'll note that 7,000, the difference between the two inventory or the write down, was actually taken within the income statement, and at the profit after tax level you'll find that this expense will actually flow from here. So assuming that tax impact or tax rate here is 0%, you'll find that the PAT level impact will be the lowering of profit by 7,000. And we know that the equation is that shareholders equity is actually linked with profit after tax. So this profit after tax actually flows here into the shareholders equity section, and shareholders equity goes down by 7,000. So we note that both the assets move down by 7,000 and the liabilities move down by 7,000 because we take the write down as an expense and it flows from the income statement. What about the cash flow impact here when we talk about the write down of inventory in this fashion? Essentially, this difference between the two, 55,000 and 48,000, this is a loss which has been recorded in the income statement, but this is not a cash loss. So when we talk about the cash flow statement, there is actually no impact from the point of view of cash flow from operations, and net impact of cash flow remains zero. So this is what the impact of cash flow would be like.